Okay, this is another statement of financial position. We're going to consolidate the parent and the subsidiary. So let's just read the question and see what it tells us. The parent acquires 100% of the subsidiary on 1st of Jan 2010. At that date, the subsidiary's retained earnings is £10,000. And what we have here are the two balance sheets for the two organisations. And we see here it is at the date of acquisition. So there's no post-ac profits to be concerned about. The issue with this one is if we look at the total equity of the subsidiary, which is what the parent has purchased, comes to £20,000. There's other assets of 22,000, which might be plant, machinery, factories, inventory, who knows, other assets. And liabilities of 2,000, debts they owe, and that comes to 20,000 total equity. Now the parent, as we see here, has paid 30,000. So they've paid 30,000 for net assets of only 20,000, which means there must be some other element that they've paid for on acquisition, which doesn't appear on the subsidiary's balance sheet. And if you get that situation, it's going to be an element called Goodwill, which that could be client lists, it could be brand names, it could be goodwill in the community, it could be knowledge in the staff, things that are difficult to quantify, or in fact according to the standards you are unable to quantify, but still form part of the value at acquisition. So we need a little bit of working here, because we've obviously paid 30 for something that on paper's worth 20. So we need to just reconcile that difference. So we'll do a working here, working for Goodwill. And we look at the total consideration from the parent, and that consideration was 30,000. And from the consideration we look at what they've paid for. So we'll do 4, and they've paid for shares. They've paid, let's take negative, they've paid £10,000 for shares, and they've paid retained earnings, which was also 10,000. Just make that negative, and if we add that lot together, we've paid 30 for assets worth, or for equity worth 20, gives a outstanding amount of £10,000, which is our goodwill amount. Now that was fairly clear on this easy example, that we paid 10,000 more than the equity that we purchased, but it's good to start with an easy example. So we'll put that straight in the balance sheet of the consolidated group, and it goes in as an asset. It's a non-tangible asset, but we can put it in here, Goodwill, £10,000. The rest of the balance sheet is just as normal. We add across, so this is parent plus subsidiary. 65 plus 22 is 87, gives us 97,000. The shares, we only ever do the parent, because who owns the group? It's not the owners of it is the owners of the subsidiary. The shareholders are the shareholders of the parent. So we just put in the parent's equity shares here. We ignore the subsidiary shares, so it's parent only. Retained earnings, well, we're at the date of acquisition, so we can just add the parent's retained earnings. We ignore the subsidiary's retained earnings at that point. That's all contained within the goodwill calculation. And the liabilities, just add those two together. And always nice to see that the total assets equals the total equity plus liabilities of 97,000. So what have we done here? That's the end of the consolidated statement of financial position. We've had to work out a goodwill amount. We paid 30,000 for equity of only 20,000. So there's obviously a discrepancy there. And we do a small working. Let's just put the working here. Working 1. Just so that we know where these numbers have come from. Working 1, goodwill. £10,000. Our consideration, our payment for the subsidiary at acquisition was 30,000. For £10,000 of shares, £10,000 of retained earnings at acquisition gives goodwill of 10,000. We paid 30 for 20, so we've got 10 left over. That goes in as an intangible asset for the group. And then the rest is just added as normal. Other assets, be it plant, machinery, inventory, is 87,000, P plus S. Equity shares, only ever the parent, so that's 20,000. This is just the retained earnings of the parent. We're at date of acquisition, so there's no post-acquisition retained earnings. And liabilities is P plus S. Those two added together gives us 97,000. So that is the consolidated statement of financial position with goodwill.